when the average person hears that, hey, you make $100,000, your marginal tax rate is 24%, well, hey, that means that I probably pay $24,000 in tax because that's my tax rate. But that's entirely wrong because taxes are what we consider marginal. That means that brackets go up as your income goes up, but also you don't fit all into one bracket. Some of your income is taxed at 10%. Some of your income is taxed at 12%. Then some of your income is taxed at 22%. And then whatever's left over ends up being taxed at that 24% bracket. Let's say, for example, you made $11,000 after the standard deduction. Well, that means that you would have 10% tax on that, so about $1,100. Let's say you made $45,000. Well, from $11,000 to $44,000, you are taxed at 12%. So then you figure out how much tax you're paid on there. So then if you make $90,000, then the difference between 45 and 90 is taxed at 22%. Basically, all this means is that you're not all taxed in one bracket. Part of your income is taxed in each part of the bracket, not all in one. That's what we really mean by marginal. So then when we talk about effective tax rate, we're looking at the average amount of tax that you're paying. So if you made $100,000, let's say, and you end up paying somewhere about like $18,000 in tax, that means your effective tax rate would be 18%, even though you are now in the 24% tax bracket. So this is what people really mean when they're talking about marginal brackets and then what effective brackets are. The next term that we need to go into is credits and deductions. Both of these are ways to reduce your taxable income, but people often mistake the difference between the two. So a deduction is basically a reduction of how much that you're going to pay in taxes times your tax rate. So if you make $100,000, you have a $10,000 deduction. Well, now you pay taxes at $90,000 times by your income rate. That ends up saving you on taxes by $10,000 times that marginal rate, the top bracket you're in, which is 22%. So on a $10,000 deduction at $100,000 of income, you would save $2,200 in taxes. Credits, on the other hand, are a direct dollar for dollar reduction in your tax bill. So if you make $100,000 and let's say, that means you pay $18,000 in tax, if you have a $10,000 tax credit, it means that you now subtract that from what you owe on taxes. So instead of owing $18,000 in taxes, you now owe $8,000 in taxes. So obviously credits are a lot more beneficial, but they're honestly less common. Most of the things that you would use, like an HSA, a 401k, a traditional IRA, those are tax deductions. So they reduce the amount of taxes you owe by that amount times your marginal tax rate. Versus tax credits, on the other hand, for example, there's one right now for if you buy certain cars that are electric, you'll get a $7,500 tax credit. That will reduce your tax bill by $7,500. So there is a key distinction there between those two. Now that you understand income taxes, we can start to go to capital gains taxes. So first way to start talking about this is understanding what a capital gain is. So let's say you buy shares of Apple, they're worth $100 and you sell it for $200. That means you have a $100 capital gain. That is what a capital gain is. It is when you buy an asset and you sell an asset for more than you bought it for, whatever that dollar amount is considered a capital gain. And you are taxed on these capital gains. This is something that a lot of people don't think about and they don't know. And so they keep buying and selling investments and buying and selling investments, and they don't hold enough for taxes. And then they end up owing taxes when due. Maybe the stock market's down and they don't want to sell and they find themselves in a tough spot. We want to help you avoid that and plan for that. So first, to understand what you owe in taxes, you need to know a few things. The first one is you need to know your cost basis. This is what you bought it for. So this example was $100. That's your cost basis. Then you need to know what you sold it for. In this example, $200. Then you figure out what's that gain. Now here's where things get a little bit more difficult. You need to understand how long you held this investment for, because how long you held it for changes how you are taxed. If you held it for under 1 year, then you are taxed at short-term capital gains rates, which is basically just your income rate. So you'll go look at your income. If your marginal tax rate is 22%, then if you sold within 1 year, you'd be taxed at 22%. So on that $100 gain, $22 would then go towards taxes. That's short-term capital gains. Long-term capital gains has favorable rates. So if you hold your investment for over a year, then you get taxed at long-term capital gains rates, which is either 0, 15, or 20%. If your income's really high, you can also have what's called net investment tax, which is another 3.8%. But this is something that you need to know your income to understand what you owe. For certain people in lower incomes, you have room for 0% capital gains. For other people, and most people, you're probably in that 15% range. So in this example, you held it for more than a year. You're at 15% long-term capital gains rates. Then on that $100 gain, you would owe $15 in taxes. The key here is you want to be aware of it and save for it. Make sure when you're making these trades and you're making these sells, you know what your tax liability is and you set it into some account to withhold for taxes that you're going to owe later in the year. And if you end up with having a huge tax liability, a huge gain, you might even have to go pay quarterly taxes. We won't get into too much of that today, but you can go look that up online, how to pay quarterly taxes, and the IRS will help you do that. Now that you understand how capital gains are taxed, we have to next go to dividends. If you're on Twitter, like probably many of you are, you see so many millennials talk about dividends. And I get it. Like dividends are, when you look at research, a great way to build an investment portfolio, but a lot of the information is skewed. Dividends are really a company choosing to pay out part of its profits to you and then you be taxed versus choosing to keep those profits in the business to grow the business. Dividends don't necessarily make it for sure a good investment. They don't also make it a bad investment either. Regardless, I need to explain to you how they're taxed. To understand how they're taxed, you have to split dividends into two parts. You first have ordinary dividends. So these are ones that are going to be taxed at your income rate. There are a lot of people who own tons and tons of dividends. So this is really important to track and make sure that you have enough saved because that is forcing you to pay taxes. Then there are qualified dividends. Qualified dividends actually have more favorable tax setup. And so they end up being taxed at long-term capital gains rates as we talked about above. So 0, 15, or 20, you need to go look at based on your income, what bracket you'll be in to understand that you need to save. But the key distinction here is understanding what type of dividend they are and then what that tax rate will be for you so you can end up saving and not have a surprise come tax time. Thank you for watching. And if you like this video, please leave a like and go subscribe to my channel for more personal finance content. And as always, we'd love to hear your thoughts in the comments below. See you back next week.